If you're a veterinary practice owner, associate, or practice manager, this time of year can feel a little overwhelming. You're finishing the year strong clinically, you're managing staff, and suddenly tax conversations start popping up everywhere. What I want to do today is give you clarity without adding more work to your plate. This training is specifically about year-end tax moves you can still make that do not require touching your practice books, changing your accounting systems, or overhauling anything operationally. These are personal side strategies that can materially reduce your 2025 tax bill if you act before year end. And they're especially relevant for veterinarians because of how income, benefits, and cash flow usually show up in this profession. Let me make sure this is working. Looks like it. Okay. So today we're going to walk through 5 smart, practical year-end moves that lower your 2025 tax bill without reopening QuickBooks or rehashing your financials. These are strategies that live outside the day-to-day operations of your clinic, but still create real tax savings. We're going to cover health savings accounts, retirement contributions, estimated tax planning, charitable giving, and timing strategies. None of these require you to redo your books, change payroll, or dig through reports. They're decisions, not accounting cleanups. If we haven't met, I'm Cassie Sykes. I'm an enrolled agent, and I work almost exclusively with veterinarians and veterinary practice owners. I don't just prepare tax returns. I spend a lot of time helping vets understand how today's decisions affect next year's cash flow, stress level, and tax exposure. I see a pattern every year where smart, hardworking clinic owners overpay simply because no one showed them what was available outside the books. This training is about changing that pattern. The first move is your health savings accounts. An HSA is one of the most underused tools I see in veterinary households. If you're covered by a qualifying high deductible health plan, an HSA gives you a rare triple tax advantage. Contributions reduce your taxable income, the money grows tax-free, and withdrawals for qualified medical expenses are also tax-free. That means it's not just a deduction, it's a long-term planning tool. What matters at year end is that you can still fund an HSA for the year even if you haven't been contributing regularly. As long as you're eligible, you can make a lump sum contribution and take the deduction. For vets with high income years or inconsistent cash flow, this is often one of the cleanest ways to reduce taxable income without affecting the practice at all. The second move is an IRA contribution. IRAs are another area where timing matters more than people realize. Depending on your income and filing status, you may be eligible for a traditional IRA deduction, a Roth IRA contribution, or a backdoor Roth strategy. Even if you can't deduct the contribution, the long-term tax planning benefit can still be meaningful. What I want you to think about at year end is not just whether you've contributed, but whether you've contributed intentionally. Many veterinarians earn too much to deduct an IRA and assume that that means it's not worth doing anything. That's definitely not true. The structure and timing of contributions can still support long-term tax efficiency and future flexibility. Estimated taxes are where I see the most stress and the most avoidable penalties. The goal is not perfection. The goal is being safe, predictable, and strategic. Year end is your chance to review what you've already paid, compare it to last year's tax, and make adjustments before penalties become an issue. For veterinarians with variable income, relief work, bonuses, or ownership distributions, estimated tax planning is less about exact numbers and more about guardrails. Knowing whether you're on track, behind, or safely ahead allows you to make informed cash decisions before December 31st instead of reacting in April. Charitable giving can be both values driven and tax efficient, but only if it's done intentionally. Writing checks in December without understanding how the deduction works often leads to disappointment. What matters is whether you itemize, what types of assets you're giving, and how the timing lines up with your income year. For higher income veterinary households, strategic giving can include bunching donations, donor advised funds, or contributing appreciated assets rather than cash. These strategies don't require practice level changes, but they do require planning before year end to be effective. Timing is one of the simplest but most powerful tax tools available. The question is not just how much you made, but when income is recognized and when deductions are taken. On the personal side, this can mean accelerating or deferring income, timing bonus payments, or choosing when to pay certain deductible expenses. Even small timing adjustments can shift taxable income from one year to another, which matters. If you expect income changes, tax bracket changes, or major life events. These decisions are often missed because they don't show up clearly in bookkeeping reports, but they absolutely show up on the tax return. Each of these strategies can absolutely create savings on its own, but where I see the biggest impact for veterinarians is when they're used together intentionally. An HSA contribution might lower your taxable income. Estimated tax planning helps you avoid penalties and cash flow shocks. Timing strategies lets you decide which year income or deductions land in. When these pieces are aligned, you're not just saving money, you're reducing uncertainty. What that means in real life is fewer April surprises, fewer last minute scrambles, and more confidence around what your cash actually needs to support. Instead of reacting to whatever the tax return tells you after the fact, you're shaping the outcome ahead of time. And that's the difference between feeling like taxes are happening to you versus feeling like you're in control. The goal here isn't to chase every possible deduction or make your life more complicated. It's to build a predictable, repeatable system on the personal side that supports your income, your family, and your long-term goals without adding more operational work inside the practice. When these strategies are layered correctly, taxes become part of your plan instead of a stress event at the end of the year. As you're listening, I want you to ask yourself a few questions. Have I fully used the tools available to me personally, not just through my practice? Do I know where I stand on estimated taxes right now? Am I making decisions reactively or with a plan? If any of those feel unclear, that's not a failure. It's a signal that planning would help. One of the biggest mindset shifts I encourage veterinarians to make is moving tax planning out of crisis mode and into a routine. Most of the stress I see around taxes doesn't come from complexity. It comes from everything being deferred until the very end. When planning only happens in March or April, it feels urgent, reactive, and overwhelmingly by default. Year-end planning shouldn't feel like a fire drill. It should feel like a normal checkpoint, a simple annual rhythm, a mid-year check-in to see where income and payments are tracking, followed by a focused year-end review. It can prevent most surprises before they ever happen. That approach gives you time to make decisions intentionally instead of under pressure. What that rhythm really gives you back is mental bandwidth. When you know where you stand, you stop second guessing every spending decision in December. You're not wondering whether you should hold cash, prepay something, or brace for a tax bill you can't yet see. Instead, you're making decisions with clarity and confidence, and taxes become one input in your financial picture, not the thing that dominates it. If what we covered today highlighted any gaps, uncertainty, or just a sense that things could feel more organized, that's completely normal. Most veterinarians aren't missing effort, they're missing clarity. The challenge isn't knowing more strategies, it's understanding how your income, personal planning, and cash flow actually work together in real life. If you want help applying any of this to your actual numbers, you can book a free profit and cash flow analysis. Together, we'll walk through your income, household setup, and cash flow, identify what's working, where things are leaking, and map out clear, practical next steps. No pressure, no jargon, and no unnecessary digging into your practice books. If you'd like to, you can book your free consultation or book your free call at the link on the screen. I'm also going to drop it in the comments. Before you go, I want to share an incredible resource designed to elevate your veterinary practice's financial success. I put together a free ebook just for you. It's called 7 Financial Strategies. Inside it, you'll discover practical steps to increase profitability, improve your cash flow, and make smarter financial decisions for your practice. You can grab your free copy of the book in the comments. All right, that's it for today. If this helped, please pass it along to another vet owner or friend who could use a clearer picture of their numbers. And if you're ready to get yours dialed in, go ahead and book that free profit and cash flow analysis. See you next time.